Strategy number one is going to be a broken long butterfly. You can see how you can risk $89 to make over $400 in return on this trade. Even if you don't hit the maximum profit, it's very easy to manage this position, especially if the stock is bearish. And that's why I'm going to go over this strategy in great detail, because it's one of the best strategies for growing a small portfolio, especially if you're broke. And if you're struggling with limiting funds for trading, this is going to be one of the best strategies for you, because you can essentially trade less than $100. So don't have a lot of money? No problem. The first strategy I'm going to cover right here is just going to be $89. So let's discuss setting this up. I'm going to exit out of this 170, 175, and 167. So we know that Tesla just recently reported earnings, and the earnings were not that good. And luckily, I don't have much of Tesla in my portfolio right now, because so I'm neither here nor there. I'm making a lot of money on other stocks that's not Tesla. But now that Tesla reported earnings and they're pretty bearish, I want to show you a strategy where you can just put up a couple $100, well, actually less than $100, and get a pretty decent return. So what I'm going to do is I'm going to go to April 28th. If you're watching this in the future, this strategy pretty much works the same way regardless of when you're doing it. The main takeaway is you basically just want to go out maybe a couple days up to a couple weeks. Right now, I'm going to do an 8-day option. Now, there's a lot to this, okay? The first thing that I want to do is I basically want to find my base, okay? So since Tesla fell down, I don't think it has that much room to fall, but it could pull back just a little bit more. So what I'm going to do is I'm going to form my base by selling a call option. So this call option that I'm selling is essentially going to be the top of my butterfly, okay? So I'm going to sell the 167.5. That means if it ends at 167.5, that's basically my peak. That's like my Christmas tree, my very top of the mountain. That's where I'm gonna make most of my profits. Now, it doesn't have to end at this price point, but if it does, this is where my maximum profit will be. Now, what I'm going to do is I already have a base. Now, I'm gonna go to buy a call option. I'm going to buy a call option that's above my current strike price and below my current strike price. So the first thing that we can do is the one above. I'm going to go $500 higher. So the current strike price is 167.5. I'm going to go up to 172.5. Let me just expand this option. And the delta is 0.67. So this is a very high delta. That means there's a high chance of this happening. Hence, this is kind of a risky strategy. This is one of the riskier strategies that I'm showing on this YouTube channel. Usually, I'm not running a strategy like this, but if you don't have a lot of money, hence the title, broke, then you do basically have to use strategies like this. Unfortunately, I wish you could sell covered calls or sell puts and have 100 shares, but if you have a very, very tiny account, then this is what you're going to have to do, okay? So you're gonna wanna go ahead and buy the 172.5, all right? And now I'm also going to buy $500 below my base of 167.5. So I'm gonna go ahead and buy the 162.5, and as you can see, delta is very high here, but this doesn't really say anything because this is not really a one-legged option trade. This is not a two-legged option trade. This is a three-legged option trade, and I'm gonna show you based on the payoff chart in just a second why this leg doesn't really matter as much. It's basically just to balance out this sell call option that I'm doing. So let me do the 162.5, so I'm gonna go ahead and buy this. Now, this chart is not gonna look that spiffy because it's not correct yet. What you wanna do is you actually wanna have a custom order, a custom amount of legs. So right now, it's just a normal ratio. There is one sell call and there's two buy calls, and that's not good. What you wanna do to set up this iron butterfly is you wanna go to custom and you wanna make sure that there's at least one sell for every buy. So there's a total of 2 buys, and I want there to be a total of 2 sells. And now you can see how this is a very similar trade. I did go out a little bit different in terms of my strike prices, which is why this looks different from my original example. But this is actually even better. I mean, this is $68 that you're risking to make $432. This is over a 6x return in one trade in 8 days. So as you can tell, this is a very insanely profitable trade. But there's a caveat. You really do need the stock to be somewhere around this base point of 167.5. Now, it can go lower, and that's fine. You're still gonna be in a profit zone. It can also go a little bit higher, and you're still gonna be in the green profit zone. But your break even right here is going to be 171.82. Then on the bottom side is gonna be 163.18. So if you're slightly bearish, that's good, right? Because if Tesla comes down a little bit more, then you're basically gonna be around your peak point right here, which is gonna help you essentially 6x your money. But if you can't get exactly at this peak, that's fine. If you end up going right here, getting a $250 return, that's still a 4x on your money, so that's fantastic. But you really do need the stock to bounce in this area. And from one perspective, this is not that different from an iron condor. However, this is a little bit more tight. This butterfly only has room for downside by about $9, and on the upside, it's only about $3. So it's a nice tight range, and you can make a lot of money on this. Now we want to talk about management because managing this position is not fun. So a lot of students will ask me, do you like iron butterflies? And the truth of the matter is I don't really like it because of how hard it is to manage. Now, if it was not hard to manage, I think I would like the strategy a lot more. And the reason why this is so hard to manage is because there's 4 legs, okay? There's 2, 3, 4. And the more legs you have, the harder it is to close the position. And that's because if you're just doing one trade, right? Like right here, 20 and 21, this is already an awfully wide bid-ask spread. So the bid-ask spread here is $1.10. That is a lot. Just for some example purposes, Apple can have a difference of like 1, 2, or 3 cents. This has basically 50 times more spread difference than Apple. So that's not ideal, especially not ideal for an iron butterfly. However, I will also say the implied volatility is so high on Tesla that does make it a good candidate for the iron butterfly. So there are some positives, but there's also some negatives. And that's just something that you have to be cognizant of. Let me show you this on a different stock. So Tesla has high implied volatility. We can go to something like Apple. Apple is going to have very tight bid-ask spreads, which is very good. That means there's very little slippage cost. Okay, I'm going to show you something slightly different. So we're using calls to basically set up an iron butterfly, but you can also use puts to set up an iron butterfly as well. So what I can do is I can sell a put option. So let's just go ahead and sell a 165 put option. But I do want to go out further in terms of date. Let's go again and do 8 days until expiration. So I'm going to go ahead and sell the 165. Now I'm going to be, pretty tight actually. Let's go very tight. So instead of going 500, we can go 250. And there's just pros and cons. I'm going to explain the pros and cons as soon as I set this up. So if I do the 167.5, which is only $2.50 higher, okay, and then I also go, $2.50 lower to 162.5. Okay. Again, I want to go into the custom order section right here. I'm using Robinhood. I've been with them for a long time. They always give me special bonuses for my members. So if you want to open an account, I'll link that in the description, but you already probably have Robinhood. So no worries. You can use any broker. It doesn't really matter. So I'm going to go to custom. I'm going to go to sell. So I'm going to change this 1 to 2. And that's because, again, I want to make sure that there's at least 1 sell for each buy. So there's 2 buys and now 2 sells. Now you can actually see here that this is a very similar position. Not much has changed. In fact, the chart looks exactly the same, but the return is actually amazing. This is a really tight iron butterfly. So the good news here is actually that it's only $39. So you can literally put up $39 to make $211. This is, again, over a 5x return. So if you want to 5x your money in literally a week, this is the best strategy. Is it safe? Well, it's not as safe as doing out of the money spreads, selling puts, covered calls, or basically any of the other strategies I talk about. This is probably one of the riskiest strategies that I will discuss on YouTube, but I do think that there is a place for this strategy, especially if you have a lot of free time, to manage this position, because if the stock does go down in the short term, you can end up making a really huge profit intraday. So what I mean by that is if Apple goes down by just 1%, this position is going to see a really huge gain because it's essentially banking off of reaching somewhere around this point. So if you're bearish, then you want to do this. Now, if you're bullish, you can actually just do the same strategy, but you would want to change it up. So I made the base at 165. Wherever you think this will go to, so say you think Apple will go to 170, you will have to adjust for that strike price and create a base at exactly the price that you think the stock will end at. So it's kind of like a guessing game. It's almost like a lottery, and this is a buying strategy in some cases. So I typically wouldn't teach this on my channel, but again, I do think there's a place for this, especially for small investors, especially for investors that are a little bit riskier, having tiny portfolios, any of those type of things, or just being honest. Some people want to have fun. They want to put a small amount of money in and see if they can have a really big payoff, and this is a strategy for it. Now, I wouldn't use this strategy for more than like 5% of your portfolio. Heck, I probably wouldn't even open more than 1% of your portfolio if you have over $50,000. You probably only want to throw in like a couple $100 on this strategy. But the good news is a couple $100 can turn into $1,000. So again, let's just pretend that you're bullish. So what I'm going to do is I'm going to change this strategy right now. So instead of this currently being bearish, because obviously Apple's at 167, and the peak price here for making the most amount of profit would be 165. So this actually wouldn't even be that much of a decline. Apple would only have to pull back like literally 1%, and you can see a 5x return in 8 days. So this isn't a complete stretch, But again, it's probably not super easy for it to end at exactly 165. But for this example, as long as you're between 162.89 and then you're under 167.11, you're gonna see a profit, and that's probably going to happen. So in my opinion, even if it doesn't go to a full profit of $211 and say that you turn $39 into $78, which is just a double on your money, that's fantastic, right? I mean, the thing is, you're probably not going to put up a lot of capital. You might be a little bit crazy if you put up, thousands of dollars, because the likelihood isn't super high to reach your max profit. But I will say, if you just put 500 bucks on this, there is a high likelihood that your 500 could turn into like 700 or 800 if you manage it correctly. Obviously, you kind of have to watch it like a hawk. So if Apple pulls back 1%, you could end up seeing a return of 20, 30, or 50%, something like that. And then I would just close out this position. So I would probably never really hold this position until expiration. As long as I see a return of like 50 to 100%, I'm probably gonna close out this position early. Now, of course, you can hold it until expiration, especially if it's around its profit area. So if Apple's at 165 and it's basically going sideways, that's kind of a dream scenario. And in that case, I would hold this until expiration, because at that point you have a high likelihood of achieving your maximum profit. So this is clearly a bearish butterfly. What I want to do is essentially show you how to have a bullish butterfly. So all you really have to do is I'm going to reverse this position. So I'm going to go ahead and buy back both of these, and let's go ahead and sell again. So let's say that you want your peak of the pyramid or your peak of the butterfly to be 170, okay? Or let's just say 172.5. Let's say that you think that Apple is going to go to 172.5, and that's, a pretty bullish move in the next 8 days. And that's fine, right? It's based on your view. So let's go ahead and sell a put option at 172.5. Now I'm just going to buy the 170, okay? I'm also going to buy the 175, okay? So going one below strike, one above strike. I'm actually gonna play around. I'm gonna show you 2 above strikes and 2 below strike, but let's just do this example, okay? So let's go to custom. Again, I wanna make sure that there's 2 sells for each buy. Okay, there we go. So this would be a very bullish butterfly. So as you can see, I'm risking about $55 to make $195. So the return here is a little bit less. It's only about a 4x return, and Apple would have to significantly go up, okay? So in my opinion, this is not as attractive as the first example we were going over. Now, what I do want to show you though is I want to get rid of this, and I want to get rid of this, and now I want to show you the difference of doing 2 strikes, okay? So I'm gonna have a $500 difference right now. So instead of 170, I'm gonna pick 167.5. Instead of 175, I'm gonna pick 177.5, okay? So again, I wanna make sure that this custom order is correct. There's 2 sells and 2 buys. Okay, that is good. Now, as we can see here, I don't think it's actually working. Let me start this position from scratch just one more time. So I'm gonna go ahead and sell the 172, I'm gonna buy the 167.5, and then I'm going to buy the 177.5. And now again, I'm gonna try doing this custom order. All right, took a second there, but I got it to work. So as you can see, this is a very similar looking position, right? It looks the same. Apple would have to rise, and then you can make profit at your peak point of 172.5. But now the max loss is 187 and you're only making 313. Now there can only be one reason why the max loss is so much higher and the maximum profit is so much lower. And contrary to popular belief, this is actually not a worse position. Every option trade is an even money trade. Meaning if you're risking $1 to make 1,000, you're probably only gonna win 1,000 1 out of 1,000 times. Here, as you can see, this looks much less attractive. However, not necessarily, because Apple would have to go up a lot less for you to break even. So now it would basically be a break even at 169. But before, if I was doing a closer to the money trade, like I was doing the 170, the break even would have been a lot higher. The reason why this looks like a worse risk to reward ratio is because there's a higher chance of making profit. And that's why you're getting charged a lot more money to have that higher chance to make profit to begin with. So overall, a long butterfly strategy can be a really good strategy to deploy, especially if you don't have a lot of capital to work with. But if you're going for consistent income, this is not my favorite strategy. In fact, I'd rather just sell iron condors, which I have a video on right here.